Hello and welcome to the Irish Life podcast series called Embracing Investments. Here we talk with key people at Irish Life Investment Managers, or ILIM for short, who shared their expertise and insights on the main issues that impact on the value of people's pensions and investments. My name is David Haslam, and in this podcast, I'm joined by my colleague Anthony McGuinness, who's ILIM's Deputy Chief Investment Officer and responsible for developing and delivering our return and risk management strategies for investors. In other words, how we try to generate as smooth a return as possible for investors through the stock market ups and downs. We understand the uncertainty they can cause and how unsettling it can be, and coronavirus continues to wreak havoc in the lives of people across the globe. Stock markets have shown that they too lacked any immunity from the disease and were severely impacted, falling further and faster in a period of a few weeks than at any time in history. Such moves are enough to unnerve even the most seasoned investors, and many will be concerned about their savings or perhaps their pensions for retirement and wondering what, if anything, they should do. I've invited Anthony to give us his thoughts on managing investments in situations like this, whether it's €20,000 or €20 million, and looking at some of the pitfalls that he and his team look to avoid. On that note, I'd like to introduce my guest. Hi, Anthony.
Hi, David.
Anthony, I think it's fair to say that although we've experienced unusual and highly impactful events over the last 20 years, from the dot-com bubble bursting to the global financial crisis, the current crisis is truly unprecedented. It can often be hard to see these events coming. What's the best way to prepare for them?
Yeah, so we often hear people talking about the benefit of hindsight, and it is true, we can usually see after an event what we should have done better beforehand. But we actually do believe that there is some forward-looking value in terms of looking into history and that benefit of hindsight in investing. And that we can actually, look back at what's happened in the past and learn from it in terms of our investment strategies. So each of the events that you've just mentioned are very different in different ways, and it's important that we try to understand and learn from them and what we could have done differently or indeed better, and incorporate that learning into the design of our either risk scenarios or our investment strategies to help reduce the impact of economic shocks and market falls when they happen. So indeed, it is true that no two crises are identical, and indeed, I agree with you, the COVID-19 is truly unprecedented. The lessons of history can provide us with a very helpful framework for investors trying to understand and navigate both the coronavirus shock, but also other crises from an economic and investments perspective.
Okay, that makes absolute sense. So, given the variety of events we've seen impact on stock markets over the years, what have been the common lessons learned? What is it that we should all be doing?
I think there's three areas I would certainly draw our listeners' attention to. First is it's normal to expect some degree of ups and downs, or what we would call volatility, as part of the natural cycle of investing. However, I think it's really important to note that history has repeatedly shown to us that being and staying invested through those periods, even during the most difficult times, has typically generated the greatest wealth for investors in terms of retirement savings and also financial well-being. Secondly, really, again, point to this concept of the benefit of diversification. In other words, not putting all our financial eggs in one basket, but instead spreading our investments across multiple assets to avoid concentration risk. The concern here is that if all our investments are in a single asset, or country, or region, or company, and that investment actually suffers losses, it can have a huge detrimental impact, not just on our wealth today, but also our ability to achieve financial outcomes for the future. So it makes sense to spread our investments to reduce that overall impact on our financial well-being if any one of those investments do suffer a loss. So for us in Irish Life, when building portfolios for our customers and clients, we do extensive research on different types of opportunities on a global basis, which does mean that we are accessing thousands of underlying investment opportunities across different geographies, different sectors and industries, from technology to utilities to manufacturing to consumer cyclicals, and different strategies and even other specialist managers that we would look to bring that broad level of diversification to our investors. and the benefits that come with that. Finally is the area of risk management, which is a huge focus for us in Irish Life. We've invested significantly in terms of developing our research around risk management strategies, which help to reduce the impact of stock market falls on our overall portfolios and deliver a smoother investment journey and build greater confidence for our customers. This is crucial in the sense that it helps people stay invested through those ups and downs that we know is the right thing to do and is critical for investors to do. And that research that we've done consistently shows that being and staying invested over that long term, despite those short-term periods of volatility, delivers better outcomes for our investors, despite those shorter-term risks.
Okay, that's a really interesting point. Is it always better to stay invested? I would have thought surely the best outcome is to be in for the highs and out for the lows.
So, look, trying to time markets is notoriously difficult, and many investors who do try usually end up selling after markets fall. And the problem there is that inevitably leads to some degree of locking in losses that have already occurred. And then there's a challenge of getting back into the market, and that can consequently lead to missing out on subsequent recoveries. So, for example, when we've looked at history, we've seen record outflows from US equities at the bottom of the financial crisis, which was March 2009. And just before the start of one of the longest US equity bull market run on record, with gains of over 400% from those lows. So history has shown us that investors who take a long-term view, stay the course despite short-term market falls, have typically seen stronger long-term performance gains. Look, falls don't last forever. They will happen, and as I said, volatility is a feature of investing. But it is crucial to stay invested to be able to reap the rewards of subsequent recoveries. I think, it's fair to say that the old adage of time, not timing, is as critically important to investing today as it ever has been in other periods in history.
Yeah, that would certainly appear to be the case. What then would you say about these studies that you see, and I've seen myself, showing returns if you miss, say, the worst 10 days in markets, and how much higher those returns appear to be?
Yes, David, it does certainly make for compelling reading, but I think it's also true to say that I don't think ever seen or met those investors that have been able to time markets with that degree of precision. What we actually typically see is that some of the largest single day gains in markets actually occur quite close to when we see larger losses. So, for example, we saw one of the largest single day gains for US equities on the 24th of March this year, just shortly after one of the largest one-day falls for US equities on record outside of Black Monday in 87. So that just shows the challenge of trying to get in for those large gains and get out in such a short space of time. So look, people understandably will want to sell after a market fall, but there's a huge risk in terms of missing out on the subsequent recoveries. And it's extremely difficult, if not impossible, to have those up experiences without having some of the down experiences. But look, from our research, the really compelling reason to stay invested over the long term is that despite short-term market volatility and shocks to equity markets, they've never failed to recover. And those subsequent recoveries have proved extremely beneficial in terms of creating long-term wealth for investors and building sustainable retirement savings for investors. So look, the key to not losing money from our perspective during those periods of short-term volatility is not trying to time the market. It's much better to stay diversified and stay invested rather than trying to guess those days to be in or out.
As I listen to you, it all seems so obvious. So what are the challenges in actually doing this?
Well, look, it's very well and good to look back at history and we do apply significant amount of scientific and economic research to what we do to draw inferences on what might happen in the future. But we are humans, and behavioural side of our human behavioural side of economics does play a factor in terms of how we react to market falls or market rises. So, we have to recognise that we don't always act rationally or as we should, and that can have an impact, certainly, in terms of our decision making. So when it comes to meeting long-term financial objectives like pension or retirement nest egg building, we shouldn't let short-term ups and downs affect our behaviour. We should stay invested for the long term. However, we just know from multiple examples and research that people are actually twice as sensitive to losing money as they are to making money. We also know that people are highly influenced by what they see and hear in the media or from their friends and their networks. And we also know that people will have a natural tendency to want to intervene or act when something has happened, when actually, staying the course or possibly doing nothing might actually be the right thing to do on that occasion.
Okay, so final question. From an investment perspective, what keeps you awake at night?
Well, it's an interesting time to ask that question, but I think it goes back to the previous points that I've made around staying invested, being diversified, but then also trying to address some of those challenges of applying those key principles over the long term, in particular in the volatile periods. So, one of the issues that we've invested significantly in is our risk management strategies to help prevent impulse decisions at these times of crisis, which can subsequently lead to subsequent regret as we miss out on recoveries in markets. So what we're trying to do is really make the investment journey as smooth as possible for our investors, help them manage those surprises that will come, some of those downs with the ups in terms of markets. And, thankfully, I think we have a huge experience within and across our teams, across multiple assets, different perspectives, and a significant research capability that helps us, put all our effort in terms of trying to make that investment journey smoother for investors so that they can stay the course and hopefully build long-term successful financial well-being for them.
Anthony, thank you for your time and your insights. They were really interesting. If I had to capture the main takeaways for me in 10 words or less, I think they would be stay diversified, stay invested, and stay focused on the long term. It sounds so simple, but it's obviously a case of easier said than done. I think we all know just how difficult it can be to do nothing sometimes, and during this coronavirus is definitely one of those times. We hope during this experience you can take comfort in our experience. That's all from me. Thank you for your time. I hope you found this podcast useful, and I look forward to talking to you again soon.
Irish Life Investment Managers is part of the Irish Life Group and manages assets for Irish Life Assurance. Irish Life Investment Managers Limited is regulated by the Central Bank of Ireland. Information is correct as of the 25th of May 2020.